Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, we're addressing the Social Security system, and on today's show, the tax trap of Social Security. And with me today is Ken Davis, CLU, CHFC, CFP, and CPA. Hi everyone, I'm Steve Savant, syndicated financial columnist, a contributing author, and a backroom technician. Let's get down to business. Well, welcome to the show, Ken, day 3, and I have to say, Ken, just at the end of our yesterday's show, I like to pick up on it because it seems like we get our juicy subjects right at the end of the show, and I want to continue it. We talked about the survivorship because it's really important. We talk about delaying. It's not only delaying for you, but if you're married, this could have impact on your spouse. But what bothers me, Ken, you said she's taking my income. We're taking my income. I die. She files for her survivor benefit, right? Mm-hmm. She's getting mine again. Right. But now she's getting less of it, even though it's the same benefit, because she's now fallen into possibly a different tax bracket.
Well, yeah, there's two aspects here. What do you get from income from the Social Security Administration, and then what do you get to keep? Mm-hmm. How much of it's going to be taxed? And let's talk quickly about the survivorship benefit. What happens is while they're both alive, she gets either a spousal benefit or her own benefit, and the other spouse gets their benefit. When one of them dies, the other has the choice of keeping their own or taking up to 100% of the deceased's benefit. Well, we talked about waiting till age 70 in our prior examples of $2,640 a month. Well, maybe she's getting $1,200 a month. She was a teacher or wasn't making as much. Well, when he dies, she gets to switch to that. So the deferral not only takes care of the person while they're alive, it takes care of the spouse because she or he gets to pick the highest of the two. And so that's a consideration there.
So she picks the higher of the two, which of course they'll do. But then I'm single now. So that surviving spouse, may actually pay more for the same benefit.
Well, yeah, there's actually several different calculations in the Internal Revenue Code that actually are difficult or make problems for the survivor, the widow or widower, and that is suddenly instead of 2 Social Security incomes, they have 1. Granted, she gets the higher of the 2, but still it's a diminishment of income. Further tax brackets, the thresholds for community property filing jointly are higher than a single person. So suddenly, immediately, she's thrown into this threshold that's lower, where before they weren't taxed as a couple, suddenly she is. If they're making very substantial income, she may be forced to pay higher Medicare premiums because that's now, believe it or not, Medicare premiums, quote unquote, are based on and can increase if you have too high a modified adjusted gross income. So we're introducing tax concepts into another area of the government, and in my belief that's really an indirect tax. And then in the Obamacare tax for the very wealthy making lots of money, they then add both of those plus higher Social Security, higher Medicare, and now the Obamacare tax on their income.
And we're going to get into that later on this week, because to me that's just another, I think, stealth tax that's been under the radar during this whole entire implementation of Obamacare. Now, Ken, I've been with you now for a little while, and I'm very, very educated by what you've showed me. I know about this spousal thing we just talked about, where I go ahead and I elect for my survivorship benefit, but I might have to pay more tax on it, which to me just doesn't seem right. But more than that, this whole thing about municipal bond. Now, not all municipal bonds are going to cause my Social Security to be taxed. I don't think they're all going to do that.
Yeah, actually they will.
Oh, they are. So it's
all municipal interest.
So interest is interest. They don't care.
That's
all
right.
I think people, when they look at their line 20B, as we talked about yesterday, and I'm thinking, here's my municipal income, is causing I thought it was tax-free, but it's causing my Social Security to be taxed, and again, by ordinary income tax rates. I think that is a huge trap that nobody sees.
Well, it is, and I get a little bit upset at the fact that we have to talk around this. It's your municipal bond interest may cause your Social Security income to be taxable. As far as I'm concerned, let's just cut to the chase. They're taxing your municipal bond interest. Indirectly, they're taxing it through Social Security, because if they just taxed it directly, people would get upset. There actually is a Supreme Court ruling that says they can tax municipal interest. People think that it's golden, that it's untouchable. No, it can be touched. They've chosen to do it indirectly to avoid controversy and anger about the thing, but they're taxing it. Municipal bond interest through the Social Security formula is being taxed.
Well, just not, and usually when I think about municipal income, I'm thinking about preference items and things of that nature.
Right.
But there are other preference items that are flowing into the provisional income test to weigh out whether you're going to pay taxation on your benefits. Now, Ken, I mean, oil and gas leasing is another one. I mean, I'm just thinking of the ones that are preference
Well,
items.
now we've just switched from the formula for Social Security into tax preference, the alternative minimum tax. We're starting to mix up terminology. The municipal bond interest is not a tax preference item. That's a
separate.
different. That's for alternative minimum tax. This is simply for MAGI calculation purposes. Is Social Security taxable or not?
Now, so what I'm thinking of, alternative minimum tax items, are those items part of the provisional income, or is that separate?
No, that's a separate
Okay,
deal
so I could
altogether.
be paying AMT, there's one issue,
Right.
and still paying another tax on my Social Security benefits, like municipal bonding, because that's income.
Well, let's make this simple. We have the regular ordinary income taxes. We have another tax calculation called capital gain. We have modified adjusted gross income to determine taxation Social Security income, alternative minimum tax. We have all these separate calculations, and it's impossible, at least for me, to keep it all straight in your mind. Say, okay, if I get this, it's going to affect that, and that's going to affect this, and this is going to affect that. It gets crazy. So the only real solution is to either become conversant on running your own software package and becoming somewhat expert at that, hiring a tax advisor, becoming aware of some of the things that affect you. The planning can be done. Take some tools, take some advice, but it can be done.
Ken, if you don't understand how to talk about this as a CPA, because all these numbers and ideas are so unbelievable and convoluted, how can the normal American get a hand around this, or even an advisor?
They really can't. It's
right.
just too complex.
When we come back from the break, we're going to address the 20B on your IS Form 1040 again, and we're going to talk about revealing some of the aspects of Social Security benefits under attack. And I'm going to bring up a big one, the capital gain tax. And don't forget, you can request and show the documents. You can use anything we're using as sample examples from Backroom Technician at ashbrokerage.com, or you can sign up for your own 30-day free trial right out at their site at www.brtnow.com/trialsignup.aspx. We'll be right back after the break.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life, from one of the largest distributors of Index Universal Life, Ash Brokerage.
Well, welcome back. I'm Steve Savant with Ken Davis. And remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, at www.ashbrokerage.com. Just click on the show logo on our homepage. It'll take you right out to our site. And just a heads up, before moving forward with any of the ideas you hear in our show, especially the stuff we're talking about this week, always consult your tax advisor or legal counsel, as well as your broker-dealer compliance officer. Well, let's get down to business. We're addressing, going back to 20B, it's like 2B or not 2B, 20B of my IRS 1040 form on my first page. And we're talking about revealing some of the Social Security benefits that are under attack by ways I never even thought could have been invented by the government. Here is another area, Ken, I want to talk about. And that is, and I'm shocked by it because I'm going to 20B and I'm saying, wow, my Social Security is getting taxed again. So I go back to find out, where is this coming from? Because so many Americans think, why is my Social Security being taxed? And surprise, this was a surprise to me. How can a capital gain, which I thought was I paying 15, or if you're at the top bracket, maybe 20, how is that number affecting my Social Security? I have seniors that are doing long-term investing in their retirement, and they're sitting there taking their Social Security, they go to 20B, they look at that line, and they trace it back, and they go, how can my my capital gain income trigger this?
Well, let me give a little tip, a heads up. The tax law is complex and it's a little hard to visualize, but the tax return, believe it or not, is a great graphic process to help show us an outline of how it all happens. And simply print out off of irs.gov, Form 1040, page 1 and 2, and just follow it through. Just look at the line items. First one is wages, and then we get into interest and dividends and capital gains, etc. That's all increasing. Then there's certain kinds of deductions to reach adjusted gross income. So you can look at these inclusions of income at the top of the page, they're the ones that are contributing to the total balance of adjusted gross income at the bottom to determine whether or not Social Security is being taxed. Okay? So, if you want to get some kind of handle, pull your tax return out, see where those income items are coming from, and then ask this question: is there anything I can do about that to reduce these items?
Well, I want to talk about that because, and this is no negative aspersion on your community of CPAs and accountants and enrolled agents of the IRS, but sometimes we're more reactive in that community than we are proactive. If I look on my line and I see 20B, I'm thinking, man, I'm doing something here. And now I was investing in capital gain treatment. I was hoping to get a lower tax bracket on my investments. I already paid ordinary income tax and I earned it. Now I invested it and now I'm subject to capital gains. Well, at least it's less. But I didn't realize that my capital gain was flowing directly into the provisional income test, not the tax, the entire gain flowing into that. I didn't realize that, and I'm telling you, Ken, we're going to get consumer and producer questions on this because most people say, I never knew that I was paying, that triggered and touched my Social Security taxation for my benefits.
I've been focused on Social Security taxation for years. And I actually had to sit down and do what I just advised people to do and start looking at the flow of the tax return. Capital gains are reported on Schedule D, as in dog, for 1040. That's where we show the calculations of whether or not we have capital gain, taxable capital gain. Well, that number then flows to the front page of the return. Okay, so nowhere is there any diminishment on Schedule D or the front page. That comes in at full value. If you get 10 grand of capital gain, 5 grand of capital gain, 100,000 of capital gain, that flows to the front page of the return and hits adjusted gross income. That means it's included in the formula to determine whether or not Social Security is taxed or not. So that confuses people. They say, well, I thought it was 15 or 20%. Well,
So did I. It confused me, I have to say.
That's true, and that's where looking at the flow of the tax return is very instructive and helpful to visualize what's going on. Page 2 is where the tax calculations are actually made. And what will happen is you'll come up with your total taxable income, and then you're going to have to go to a subsidiary form that doesn't show up there in the instructions, and you're going to break out how much is cap gain, how much is ordinary income. You're going to apply the separate rates. There's some other machinations going on there, and then those numbers are added back together to come up with the tax on page 2. So the confusion is they're thinking 15 to 20%. Well, no, that's page 2. We're still on page 1 and trying to determine how much of Social Security is taxed. Now, here's another subtle point. Guess what? We're computing how much of Social Security is going to be taxed. We put it on line 20B. What does that do to AGI? It increases it.
It increases, yeah.
So we're computing what the increase is going to be. It runs through, we have to recompute it again. We have to go through a circular calculation about 3 times. So the inclusion actually increases what the inclusion's got to be, if anybody can make any sense of that.
Yeah, I mean, so basically, every time I return to the front page, it affects my adjusted gross income. I have to go back and, again, go back into this. So it may take me 2 or 3 iterations or passes on this
Right.
just to get it right. And I'm thinking that's from your point of view as a CPA and an accountant doing our taxes. So I'm I'm sorry to say, freaked out a bit when I'm thinking I'm trying to sit there with a Quicken software or whatever my software is. I'm doing my own taxes. I'm going, is that tax thing doing this?
Well, and I just want to make a point. I know we put a caveat, but I don't do tax returns anymore. I use tax law as it relates to insurance products and other types of strategies to increase the amount of income, reduce the taxation. People are advised to work with their own advisors and make sure the stuff gets done right. As you can see, it gets rather complicated.
I think it's really complicated, and I'm for making our tax system simple and maybe one page all in. That's my dream. I'm not a Steve Forbes guy by nature, but boy, I got to tell you, he might have had something right about that.
I would agree.
Well, that's our show for today. I want to remind you that you can read all my online insurance commentary, advisor blogs, and articles on producersweb.com and answer any of the consumer questions that I talk about. You can read it right on Insurance Library. And remember, all of our shows are on our on-demand video section located at ashbrokerage.com. So don't forget, you can follow me on Twitter, Facebook, LinkedIn, or just email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. See you tomorrow.